Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of our very own fee-only certified financial planners. Please note this podcast is intended for educational purposes and should not be considered financial or investment advice, as we do not know all the variables to one's personal situation when answering a question. Before we jump into today's question, a shout out to our extraordinary YFP financial planning team that makes this segment possible. Your Financial Pharmacist offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to pay off your student loans, make the right investment decisions, or simply build a solid financial plan, we'll help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. This week's question comes from Tuong in Orlando, Florida.
Hi, this is Tuong Vivo from Orlando, Florida, and I was wondering about how to allocate my 401k to grow it to the fullest potential.
Thank you, Tuong, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, so we get this question a lot, Tim, and I think it's cool to ask this question really because a lot of people, when they come, speak with us, I ask that question like, well, how is the 401k allocated? And I get shrug emoji, right? Like I don't really know, or it's probably in the default like target date fund based on age, right? So I think Tuong, you asking is again, I think the next step in the evolution of like how you can grow it to your fullest. This is not investment advice, but I can kind of give some considerations in terms of how you're looking at it. Now, generally a good rule of thumb here is the bigger your employer, typically the cheaper your 401k is to you. So you might be saying, well, Tim, I don't pay anything for my 401k. And in fact, you do. So really there are a number of fees that, can be at play here. The biggest one is expense ratio. So that is the money that the different mutual funds that you are in basically skims off the top. I guess to you, a not so great word for them to be able to run their fund, right? So I'm a fund manager on Wall Street. I am running this international equity fund. I need to pay for information. I need to pay for my salary, analysts' salaries, office space, et cetera. So that takes money. So we're going to take off 0.05, 5 basis point, 0.1%, and take that money so we can run. So that's called expense ratio. The other thing that you see are things like administrative fees. So these are the things fees that are paid to cover things like bookkeeping and just the management of the plan. And these are typically collected by the custodians. The custodian might be Fidelity or Vanguard or one of those that you basically see their name on your statement. And they often will sometimes split that with third party like TPAs, like bookkeeper, that type of thing. So those are going to be the two big things. Sometimes there might be an advisor involved where you're paying an advisor as well. So there might be a percentage that you're paying to he or she. But the big thing to look at when you are evaluating your 401k are the funds that are in there. And you're going to see things like small cap and mid cap and large cap or bond. You might see international, you might see real estate. You might see stable value or socially responsible or a real asset index or emerging market. You might see value or growth funds, and you'll probably see a lot of target date funds. So I'm looking at a large retailer's 401k, and we use a tool that allows us to kind of dig in. And there are things like, all of those things that I mentioned. And to give you some context, this particular client that's working for this big retailer, her all-in expense for her portfolio was about 20, we'll call it 20 basis points, 0.2%, which that doesn't sound bad, Tim, right? That's pretty good. I think the average is about 1.68. On a $100,000 portfolio, 1.68% is $1,680 per year that either the funds or the custodian sucks up to run that 401k. So our client was paying about 0.2%. So we'll call it $200 on every $100,000 portfolio. And then after we kind of worked with her to reallocate and rebalance to an allocation that met her needs, we divided that cost by 4. So went to 0.05% or $50 on 100,000. So to me, setting the asset allocation, there's nothing wrong with target date funds, but they're going to be a little bit more expensive. And if you've ever listened to me talk about investments, expense is a major driver in your ability to build wealth over periods of time. So if you can drive down expense, if you can look at the ticker symbols. So this particular fund doesn't have ticker symbols, so they're proprietary to their 401k. But a lot of 401ks are built out of public funds. You can look in and actually see, hey, this large cap that's charging me 1% and this large cap that's charging me 0.05%, so 20 times more expensive. It should actually look in and look at the underlying funds, which are typically Facebook and Amazon. It's the same stuff, right? So those are things to look at when you're building out your asset allocation, is really look at what are you paying in terms of all-in expense. And then if you want to be a little bit more adventurous with outside of target date and maybe drive down the cost, we typically look at things like large, mid, small, emerging market, international, bond, and real estate. So Tuong, hopefully that helped. It's a great question in terms of how to tackle the 401k, which, by the way, for a lot of people is going to be one of the biggest assets on their balance sheet over the course of their career.
Great stuff, Tim. And I would just add, recently, episode 208, you and I talked about why minimizing fees on your investments is so important. So you hit some of the highlights there, but certainly some more information to dig into if folks want to check out 208, and we'll link to that in the show notes as well. Tuong, thank you so much for taking time to submit your question. And as a small thank you, we're going to be sending you a super comfy YFP t-shirt. And to those that are listening, we'd like to feature your question on an upcoming episode. So please go to yourfinancialpharmacist.com/askyfp or send us an email at info@yourfinancialpharmacist.com with your question. Have a great rest of your week.